Welcome to the Wespath second quarter economic update. I want to start, Dave, by referring to your monthly investment report for June. You reported that inflation was 5% for May, and you also reported that there's a debate regarding whether this current surge in inflation is temporary or what some refer to as transitory. So what are your thoughts regarding this bout of current inflation and how long it will last?
Yeah, Joe, to answer your question, I presently fall in the transitory camp. Though I do think we will likely see elevated levels of inflation at least through mid-2022. As we know, the Consumer Price Index rose 5.4% on a year-over-year basis in June. This follows May, when the CPI jumped 5% year-over-year. To demonstrate why I think it's transitory, I would like to start by looking at the components that make up the U.S. Consumer Price Index. As you can see in the first chart, housing and food comprise 60% of CPI. Note the transportation sector on this chart. Products and services such as automobiles, gasoline, and airfares made up just 13% of CPI at the end of 2020. So let's now see how price increases affected select elements of CPI in May and June. This first chart looks at several of the major components of the index: the cost of housing, food, medical care, education, and communication services. Note that price increases in May were somewhat subdued at 2.2% for 3 of the 4 categories and only 1.5% for medical care. While it is true that we saw a boost for 3 of the 4 categories in June, the numbers we see here are a far cry from the 5.4% year-over-year increase in the CPI for the most recent month. So you may ask, what caused the spike? Well, this next table reveals the sizable price increase that we saw for the transportation sector in both months. Of course, we all know that prices for these products and services cratered at the onset of the pandemic. 1 year on, prices are returning to pre-pandemic levels. Now, in fairness, gas prices are higher than they have been in 7 years. And further, the automobile sector has experienced 2 idiosyncratic events causing a shortage of new cars and a spike in used car prices. First, the world is experiencing a semiconductor shortage attributable to a confluence of various events. Second, the rental car industry, which is the biggest supplier of used cars, sold the bulk of its cars last year at the onset of the pandemic and have begun rebuilding their fleets. So even though the transportation sector makes up just 13% of CPI, the big price increases that you see in this chart accounts for 3 full percentage points of the 5 and 5.4% increases in May and June. Now, I think the last chart on the slide illustrates the market's expectations for inflation have modestly retreated from earlier highs, though it is still expecting about 2.5% inflation for the next 5 years, which is about a 0.5 percentage point higher than the Federal Reserve's target.
So then, Dave, you don't think that this current spike will persist, correct?
You know, I don't, but as I said, I do think it's likely that we could see higher levels of inflation for about another year.
Yeah, Dave, but what about labor costs? Don't you think that that will continue to drive inflation higher? And so, for example, there's a lot of talk about labor shortages, as the press reported last week that McDonald's in some states are raising minimum wage to upwards of $20 an hour. So don't you think that increasing labor costs will continue to drive increasing inflation?
Yeah, well, Joe, there's definitely a labor shortage and wages are clearly going up. This first chart shows that there are currently jobs that have not been filled. It's for over 9 million workers. And the chart on the right shows a survey of small business owners who say they've never had more difficulty finding workers than compared to today. And so the labor shortage is in fact real. Now, on this next chart, Joe, we see the labor participation rate. In other words, it's the percent of the working age population that have or want to have a job. The rate is well short of pre-pandemic levels. And here we see in the chart on the right that job growth affirms what we saw on the previous slide. The economy is short of nearly 10 million workers. So this next chart affirms what you were alluding to, Joe, when you asked your question. Wages for production and non-supervisory workers are up about 4.5%. Now, I would ignore the spike you see in 2020 as there were some anomalous factors at play, notably an economy that shut down and laid off a lot of lower paid workers in the hospitality sector. But this next chart reveals that we are seeing productivity increases. To me, this is not a surprise given the rapid increases we've seen in technology. But more important, we are seeing productivity gains from work at home, the work at home phenomenon. We've all heard the stories about how employees have experienced improved productivity since we went into lockdown a little over a year ago. Now you may ask, Joe, what productivity gains have to do with inflation? Improved productivity means less labor goes into making a product or providing a service. Hence, improved productivity partially offsets the inflation effect of higher wages. I do think that we are likely to see elevated productivity levels for the next several years. Now, I have one more comment, Joe, before we leave this topic. Up until the pandemic, for the most part, location has constrained employees and employers. The perfect employee for an employer in, say, Jacksonville, Florida, may be living in Asheville, North Carolina, and unwilling to move. The employer in Jacksonville may hire a less than perfect employee living in Jacksonville, and the employee in Asheville may go to work for a less than perfect employer in order to stay working locally. Now, the work from home trend, though, is going to be a game changer because it allows for that perfect match, which will have major implications for productivity.
So Dave, another topic that's been in the news a lot lately is related to the inflation theme, and that's the cost of housing. So a data point that you highlighted in the monthly investment report was that housing costs rose the most in 33 years. So what can you tell us about housing?
So April saw the highest year-over-year price increase in the nearly 35-year history of the Case-Shiller Index. And as you can see in the chart on the left, labor and materials shortages have also adversely affected the housing situation. That said, we have seen some recent signs that the housing shortage is beginning to abate. The one consolation is that the mortgage rate for a 30-year mortgage is still below 3%.
So Dave, what about near-term economic growth?
Well, retail sales are strong, as you can see in the chart on the left. Sales are running way ahead of trend, though clearly due to the unprecedented fiscal stimulus that we've seen from Congress. The dotted purple line in the chart on the right shows that it just took 6 months for retail sales to match, then exceed pre-pandemic levels. This contrasts with the blue line, which shows that it took 3 years for sales to recover coming out of the Great Recession that began back in 2008. The elevated levels of sales have led to inventory shortages, as you can see on the chart on the left of this next slide. The chart on the right displays forecasts for economic growth in the second quarter. We will get a first reading from the Bureau of Economic Analysis in about a week after we post this webinar. Consensus estimates are for about a 9.5% growth in the second quarter, though the Atlanta Federal Reserve is a bit less optimistic than their consensus. They're forecasting about 7.5%.
So Dave, how sustainable is this current surge in retail sales?
Yeah, I don't think anyone believes that sales will continue at the current pace, but as we saw in a prior slide, the torrid pace of sales combined with supply shortages have drawn down retail inventories. Building those inventories back will support growth at least into 2022. So growth should be strong well into next year, absent uncontrolled variants of the virus. Also, my thesis about inflation could be wrong, and the Fed may be compelled to act because inflation is too high if it thinks it will remain high absent any action that it takes.
So I imagine this robust consumer activity has been good for business. So what can you tell us about current business conditions?
Yeah, Joe, it's certainly been, and purchasing manager activity recently has set records. And while purchasing managers have seen some scale back from spring's level of activity, business for both manufacturing and services remain robust. As one might expect, this is translated into higher corporate profits across the board. While a jump in first and second quarter profits are no surprise to anyone, given the effective shutdown of the U.S. economy last year, no one expected the magnitude of the bounce back that we see on this chart for the first and second quarter.
So you just showed that manufacturing and services activity is strong in the U.S., but what about Europe and the rest of the developing world? I mean, aside from the UK, the U.S. has led the world in vaccines and vaccinating our population, but we know other countries have not been nearly successful. So what is business activity like overseas?
You know, actually, Joe, activity is really strong in Europe despite their slowness in vaccination. The recent months are very green on this chart with generational purchasing manager bullishness for all of Europe. And you are correct that some of the developing countries have been struggling. But manufacturing activity has certainly recovered, though it's not nearly as strong as what we just saw for Europe.
So Dave, you often talk about emerging markets and Wespath's investment belief that the world will experience modest and sustainable growth led by emerging markets. But as you just mentioned, the emerging world has fared poorly during the pandemic, with Brazil and India particularly hit hard. So has your thesis about emerging markets changed at all?
So, Joe, in answering your question, I do want to start by looking at about 70 years of history of U.S. economic growth. So I've shown versions of this chart before, and up until the 21st century, economic growth was consistently between 3 and 4% in the United States. But long term, there are only two factors that will account for a country's growth. They are the growth in the workforce and productivity improvements. This chart shows that we've had steady growth in workers through the end of the 20th century. But in the last 20 years, worker gains have been modest, and the future doesn't look good. The chart on the right shows that the U.S. isn't having enough children. We need to average 2.1 kids per woman for each generation to exactly replace itself without needing international immigration. Now, fortunately, as you know, there are a lot of people wanting to come to the U.S., so attracting sufficient numbers of immigrants shouldn't be a problem. But we need that to at least maintain the current size of our workforce. But I do think it's fair to say that any growth in U.S. GDP has to come from productivity improvements. And I talked about that earlier, how I think we are going to see productivity improvements going forward. And further, as I think we all know, the prospect for workforce growth is far worse in Europe and Japan than it is in the U.S. Hence, I think it's reasonable that the developed world can't possibly hope to consistently achieve 2% long-term growth rates, and most observers agree with that. The developing world, however, still has a long way to go growth-wise. So I've shown this first chart before, which is the extent to which the developing world will see a growth in the middle class. However, the chart on the right looks at middle class growth from a different angle. Over the next 10 years, there'll be 1.5 billion new middle class in the developing Asian market. And this compares to only about 175 million for the rest of the world. These 1.5 billion new middle class will be buying stuff. And we at Wespath want to be positioned in the companies that will be selling that stuff to them.
Well, Dave, thanks for that update, and we look forward to hearing more of your thoughts.
Very good. Thank you, Joe.